Hello and warm welcome to you and your money. I'm Bryan Hirsch. This evening we are focusing on investments. April was a good example of how interest rates and inflation create volatility in the markets. The moment that the investors lost belief that interest rates are going to drop, markets drop, and as soon as it appears more positive, markets have been going up. It's not only globally, but South African markets as well, with the election commitments by the various parties now to end, the government's commitment to structural reforms and investments in local projects could drive economic expansion. This will create a belief for investors that there are good opportunities of investing in South African markets. And joining this meeting is David Shapiro, Chief Global Equity Strategist at Sasfin Wealth, and Lutanda Mzilikazi, Sales Manager at 91. Good, Lutanda. David, thank you very much for joining me. David, you and I have discussed now for years about where should we be. Should we be offshore? Should we be onshore? I think we're in agreement about one thing. If you're looking for interest rates and you're looking for income, this is the place to be. But are you still feeling committed that offshore markets are far more attractive than South African markets?
Yeah, look, my scope is very narrow, in the sense that I don't like to, when I buy, put a portfolio together for clients, it's a very narrow 20-odd stocks. And I look for what I call the best companies in the world. And at the moment, all of those businesses are outside of South Africa. So I don't exclude South Africa when I look for businesses, but I try to get the best. And, we know AI is a buzzword at the moment, and this is real. So I continue to be driven by the themes around AI and other themes that we can discuss later. So I haven't excluded South Africa, but I continue to include mainly offshore businesses in my portfolios.
David, we presented a slide some months ago.
Yes.
Just want to recap for those who haven't watched the program. Including mining, 81% of South African companies earn more than 75% of their income offshore.
Yes.
And yet when you track that against dollars over the last 10 years, the global markets leave our South African markets absolutely bottom, relegated to what you would call in the soccer world championship league.
Because it's only because of the quality of those businesses. Those are all technology companies. South Africa is not technology driven. So in fact, even the UK is not technology driven. It hasn't got technology companies, and those have been the winners, and that's the reason why. So it's not because of the markets per se, it's because of the companies within the indices or in the index that has driven those markets. So South Africa, yes, we've got a lot of businesses here that do business offshore, but they're not in the technology space, mainly mining, financial.
Lutanda, you looking after funds becomes a different story, because over the last 2 years, investors have been very nervous. And they'd rather be in cash, and with high interest rates, and we talk about this is the place to be if you're looking for income, but a lot of them aren't looking for income, they're just being nervous and they'd rather stay where they are. So what is this cash conundrum you talk about?
So the cash conundrum is actually a loosely used term in the investment industry, which is used to describe the behavior of conservative investors. So what they typically do is, during periods of market volatility, they'll actually take their cash and hide it in bank deposit accounts with hopes that at least their capital will be preserved and they'll get a bit of interest on top of that. What happens is they smile at the end of the month when they see that the number on the closing statement has actually moved forward, so they've gotten a positive return. But what they forget to do is actually compare their return to that of a more aggressive or moderately aggressive investor who would have been invested in equities over the same period, and they would have possibly even earned double the return that of the conservative investor. So at the times where they're supposed to be actually taking a bet on equities is the time where they sit and hide in cash.
Are you saying they'd sleep better? Sleep better at night?
They sleep better at night.
Their portfolios up. And yet even investors who are thinking long term are all sitting in cash. I mean, I don't think there's ever been so much cash sitting on the sidelines waiting to be invested.
100%. So when we look at the ASISA stats, which basically reports the flows into the investment industry, the net number over the last year was negative 22 billion rands out. A lot of that money that went out of the investment industry definitely went into these bank deposits. The funny thing is, as much as clients actually think that they're hiding quite positively and are achieving attractive rates in these bank deposits, they're actually shy of what they would have gotten in fixed income funds, which is a step up from money market funds and back deposit rates. And it's like I said earlier, far shyer than the returns that they would have gotten in balanced funds and global equity funds alike. Going forward, where rates start dropping, when they eventually do, what they're going to see is that the returns that they'll get through their bank deposit accounts will actually start dropping without compensation on total returns. But had they considered moving into fixed income funds, then at least as the yields drop, as rates drop through the income funds, they'll get the capital return because fixed income funds actually are exposed to some duration. So I think that those clients that are still hiding in cash going forward will definitely need to find a more attractive home.
Strange long-term strategy, Dave. I mean, I understand talking about...
What Tana was saying, buy equities. Yeah.
Over the long term, 100%.
So, David, let's talk about the South African equity market. We've had a lot of companies come out of the market. I mean, I think in 2023, 23 companies delisted and aren't around. We've had the various companies now, the Empowerment Fund, we've had Shell and companies talking about disinvesting. I mean, I understand if you take pension funds, they're only entitled to invest 45% offshore over and above any other fixed investments. So they're getting all this cash flow in every day, every month. Where are they meant to put this money? And is that what's propping up the South African market?
It's a very difficult decision. You know, look, there's the one thesis that because it's a pension fund, your liabilities are in rand, therefore you should invest in rand. You shouldn't take another currency because you add a risk, even though the rand tends to be a lot weaker than those other currencies, if you get what I mean. So, and one has to look for businesses here. It's not easy. Thanda mentioned the fixed interest market, the long end of the market, which at these levels is very attractive. Remember, pension funds don't pay tax, so gross is net. So they're making very high returns here, which is far above inflation. So there is a net real return. The only concern is the value of the money, the value of the rand. But your liabilities are rand, so it doesn't really matter. To look for equities is a lot more, you know, is a little more difficult. But we still have a couple of companies, you know, certainly a handful of them that are worth looking at. You know, from a pension fund point of view, if you look at banks, very solid businesses. They don't lend money. You know, that's one thing. You can't get money out of a bank. That's why they make such good profits. You got to beg, you know, if you want to get money out of a bank. But in all fairness, you know, our financial sector is very strong, and there are a number of fairly decent operating businesses. But it's a tough economy, Bryan. You know, we're not growing, so you can't expect businesses to grow. And we're starting to get some really horrific stories coming out. The Pick and Pay story is a horror story. Here's a company that we admired so much, which is, it's half management, but also a lot has to do with the economy itself. We're having, you know, Spar, there's been Sasol, there've been so many businesses here that are really battling, that were mainstays of this market. Anglo's is the next story. We can discuss that. Let's give Latunda a little bit of time.
David, let's just talk one thing. If you're getting 11 to 13% out of the shorter, not the very short dated, but 5, 10-year bonds and even the 30-year bonds, and you're not paying tax, would you expect more than 11 to 13% on equity?
No, it's brilliant. And remember, you don't have to worry about the volatility because you're holding this for 10, 15 years. So you just have to take or bank your interest. You know what I mean? So the risk is dramatically reduced unless you believe it somewhere along the line this country is going to blow out and interest rates are going to shoot up to 20%. But, you know, to keep banking that kind of money every year, it does reduce your risks. You know, you don't have to look very far to kind of beat that.
Okay, that's for pension funds. We mustn't forget that the individual does pay tax, and gross has always got to be looked at net. What is your net return after tax? I mean, you get a small amount of abatements. I think if you're under 65, you get 22,800 in interest and 34.5, somewhere around about there. Don't quote me on the numbers, but somewhere around about there. So are you finding investors now starting to move yet?
So we have started seeing some kind of movement from bank deposit rates to fixed income funds, but not as nearly enough as they should be. So when you look at the assets that currently sit in bank deposit rates and money market funds, is about 1.7 trillion rands that sits there. And we're not seeing, you know, a complementary shift to fixed income funds that matches with that kind of AUM. I think what people, from a tax perspective, I mean, we're joking about tax now, what they forget is that during periods of high interest rates like we've had over the last two financial years, you're actually paying a much higher interest income tax, right? So you as an investor sitting with money in a bank deposit account have to pay that tax upfront out of your pocket. So the product itself actually doesn't have a tax mechanism. So for example, if you had 5 million rand that you had invested in a bank deposit account back in financial year 2021, 2022, you would have had to pay a tax income of about 74,000 Rand. Fast forward that to 2 financial years forward, and you invested the same 5 million Rand, you would have actually had an income tax of 175,000 Rand. So a quite significant increase in terms of the amount that you have to pay, and a lot of investors who are placing their money in these bank deposit accounts don't have the kind of money to pay SARS upfront out of pocket.
A big difference, because when you've got an equity portfolio, you don't price it at the end of the month less capital gains tax.
No.
Whereas when you, am I right, David? And when you're investing in these government bonds and in stocks, you actually have to pay the tax.
Exactly.
So the one, people, I think statements should actually show gain and less CGT, because people get quite afraid and they get a bit paranoid about paying CGT. Ultimately, you've always got to pay it. But David, let's just turn. You mentioned Anglos and Billiton.
Yes.
Now, these are 2 of our biggest companies. Can you see? I mean, I know there are other programs you'll be dealing on, it, particularly when you break down into the numbers. But can you see this deal coming about?
I think it's going to come about. I think there's pressure on Anglos to talk. Whether they find some common ground, I don't know. But whatever comes out of it, you're going to have a shrunk, if that's the right word, a smaller Anglos, simply because they're going to have to get rid of De Beers. They're going to have to get rid of Anglo Platts. And Anglo Platts, in its heyday, was a big money spinner for Anglos. Used to get the dividends coming through. So they will hold on to Kumba simply because Kumba is also a big money spinner. It's a good business no matter where the price of iron ore is. But what's going to come out of it, Bryan, is a much smaller Anglos, regardless. My own personal view is do the BHP deal, because BHP have got lots of muscle and can take Anglos through the difficult times that they might face in developing the copper mines, which is what this is all about. So I'm not, Anglos has been part of my life ever since I started on the market in the 70s, Anglos, De Beers, but somewhere along the line you've got to recognize that change happens.
And investors need to realize if the deal comes off,
yes,
we're going to have another big CGT event probably. Well, we'll be back with you shortly, but stay with us. You're tuned into You and Your Money.